The Western financial system is currently operating on a structural lie. Sarcastic. While every algorithm on Wall Street was firing sell signals today, while London dumped silver positions, and while New York paper prices bled to $69, the Shanghai Silver market did something that should be mathematically impossible under normal conditions. Surprised, Shanghai Silver didn't just hold, it rallied 4.83% in a single session to close at 17,094 yuan per kilogram. If you convert that to US dollars, you get a price range of $74 to $79 per ounce. At that exact same moment, the Western paper price was $69.55. That is a $10 gap between what the East says silver is worth and what the West says silver is worth. And this did not happen on a calm day. This happened while Western silver was under active, aggressive selling pressure. The West was liquidating. New York algorithms were cascading through stop-loss levels. But Shanghai looked at every single ounce being offered at those lower prices by panicking Western traders and said, "We will take all of it." This is not speculation. This is not momentum chasing. This is deliberate, systematic, sovereign-level accumulation by entities that have been ordered to buy physical silver regardless of what the paper ticker says. By the end of this breakdown, you will understand why $69 paper silver is the most dangerously mispriced commodity on Earth today. Let's look at the Shanghai Premium timeline because this data series tells a story that no mainstream Western analyst is willing to say publicly. In a functional globalized market, arbitrage should keep prices aligned. If silver is cheaper in New York, traders buy it there and ship it to Shanghai to profit. This keeps the gap small, but that mechanism has failed. For the last 6 sessions, the Shanghai Premium over New York has been a skyscraper. 6 sessions ago, it was $10. 5 sessions ago, 10, 4 sessions ago, 11, 2 sessions ago, it hit $13. Today, even after a massive rally, it sits at nearly $10. But the $9 to $13 range does not represent the real cost these buyers are paying. Chinese silver purchases are subject to value-added tax. When you stack the 13% VAT on top of the premium, the effective acquisition price these buyers are paying is $15 to $18 per ounce above the Western benchmark. Ask yourself, what kind of buyer pays $18 extra repeatedly for millions of ounces without flinching? This is not a hedge fund running a quick trade. This is a sovereign entity operating under a government directive. China has officially reclassified silver as a strategic material. It is now in the same category as military metals and rare earth elements. A nation only stockpiles like this before a prolonged conflict or a total economic shift. The buying behavior matches the classification with mathematical precision. They aren't buying for profit, they are buying for survival. The urgency behind these premiums is found in the physical reality of the vaults. The Shanghai Gold Exchange, the heart of Eastern physical trading, is running dry. Silver inventory in Shanghai has dropped to 10.24 million ounces. Think about the scale of that collapse. That is the lowest level since 2015. The Shanghai vault has not been this empty in over 11 years. While Western traders are playing with digital contracts that represent silver that may or may not exist, the physical reality in the East is a state of emergency. When you combine this with the COMEX drawdown over the past 6 years, approximately 161 million ounces of silver have been removed from global exchange vaults. That represents nearly 20% of the cumulative supply deficit that has built up since 2019. The world's deliverable stockpile is being consumed faster than it is being replenished, and the rate is accelerating violently. This isn't a slow drain, it's a structural hemorrhage. The West is mirroring the crisis in the East, but hiding it behind a crashing paper price. But the delivery data doesn't lie. December 2025 produced 65 million ounces in deliveries, a single-month record in exchange history. January 2026 followed with nearly 50 million ounces. That is 7 times what January 2024 generated. Delivery volume more than doubled in 1 calendar year. For March, 10,026 contracts, representing 52.6 million ounces, stood for delivery against only 86 million ounces of registered inventory. March delivery demand alone is consuming over 61% of the entire deliverable inventory in a single month. This brings us to the most critical number in the market, the coverage ratio. The coverage ratio measures what percentage of paper claims can be backed by real metal. Today, it stands at 14.2%. Anything below 15% is officially the COMEX stress zone. We are inside it today. For every dollar of silver futures, only 14 cents is backed by actual physical metal. The other 85 cents is backed by nothing but a promise. The leverage is 7 to 1, 7 paper claims for every real ounce. At the current drain rate, COMEX registered silver reaches zero in approximately 182 trading days. That is September 2026. This is not a projection. This is arithmetic applied to actual daily vault withdrawal data. If the drainage doesn't stop, the system breaks in less than 7 months. JP Morgan's role in this fractured market reveals a disturbing reality. In early January 2026, JP Morgan issued 99% of all delivery notices in a single day. They acted as the dominant seller of physical silver, but simultaneously, JP Morgan was shipping that same silver eastward to Shanghai at $10 premiums. Eastern buyers paid both the premium and the tax without hesitation. JP Morgan is playing both sides of the fracture. They sell physical on COMEX to manage the Western paper price, ensuring it stays suppressed. They then ship that same physical metal east to capture massive premiums from sovereign buyers. At the same time, they maintain one of the largest commercial short positions in paper futures. They are long the physical metal and short the paper contracts. They are profiting from the widening gap between the two worlds. It is institutional capture where the bank sits at the center of the fracture and extracts profit from the gap. They aren't betting on the price. They are betting on the volatility of the fracture itself. Today, a new dimension was added to the story. Donald Trump announced that the Defense Department has been instructed to postpone planned strikes on Iranian energy infrastructure for 5 days, citing productive conversations. The market reaction was instantaneous. Oil cratered. Brent dropped over 13% to below $97. This is the first significant de-escalation signal since Operation Epic Fury began on February 28th. The chain reaction that crushed silver could now reverse with equal violence. War pushed oil up. Oil drove inflation expectations. Inflation killed rate cut hopes, and the death of rate cuts crushed silver. If this 5-day pause holds, oil drops further. Lower oil eases inflation pressure. Eased inflation revives rate cut expectations, and revived rate cut expectations launch silver. The transmission mechanism works identically in both directions. The only question is whether this is a genuine de-escalation or just a tactical head fake in a war where both sides have repeatedly contradicted each other. The bears on Wall Street are ignoring the most important question. Where is the physical silver coming from? 2026 is the 6th consecutive year of a structural silver deficit. We produce about 820 million ounces from mines and 180 million from recycling. Our demand is over 1.18 billion ounces. That 200 million ounce gap is filled exclusively by draining above-ground stockpiles. The same stockpiles that vault data shows draining towards zero. Solar demand consumed over 25% of the annual supply in 2024. That demand is accelerating and is projected to double by 2030. EV demand jumped 20% last year, and now AI data centers are emerging as a massive new demand vector. Samsung's solid-state battery technology requires 1 kilogram of silver per vehicle. That is 50 times today's current usage. BMW is testing this technology this year, and Toyota is targeting mass production for 2027. Industrial demand is inelastic. A solar manufacturer in China does not cancel an order because a hedge fund in New York got a margin call. The investment channel contracts when the Fed gets hawkish, but the physical channel does not blink. Silver is no longer just a metal for jewelry. It is the fundamental conductor of the modern world. The data on positioning reveals why the next move higher will be explosive. Speculative long positions held by hedge funds have collapsed by 77% year over year. The specs have been completely washed out. There is almost nothing left to sell on the speculative side. Every trader who is going to panic has already sold. Meanwhile, the commercials, the big banks, have begun covering their short positions in the latest weekly report. When commercial shorts are covering and speculative longs are at multi-year lows, the setup for a massive re-entry only needs a single spark. The strike pause, a weak PMI print, or April delivery stress could be that spark. The powder keg is built. All it needs is a reason for the managed money to rush back in. The East versus West divergence is the most important structural story in precious metals today, and almost nobody is covering it properly. The Western financial system operates on paper, futures, and digital promises. When a Western trader wants silver exposure, they buy a ticker symbol. They want price movement, not metal. Eastern buyers, state entities, Indian importers, and Middle Eastern funds want the physical bar. They want the metal itself. These two systems are now pricing silver completely differently. The paper system says $69. The physical system in Shanghai says $79. In India, premiums in Chennai are rising even higher due to massive local demand. The paper price is set by participants who will never take delivery. The physical price is set by participants who already have. When lease rates hit 30 times normal levels during the January squeeze, the physical market briefly overwhelmed the paper market and silver touched $120. The Shanghai premium did not disappear when the crash came. It held firm at $9 to $13 every single session. Through the sell-off, through the Fed's hawkish pivot, and through the war chaos, the physical buyers did not care. They have done the math on inventory depletion, they have mapped out the delivery records, and they have concluded that $69 paper silver is a historic mispricing that will not persist. One side of this market is catastrophically wrong about the value of silver. The vault levels, the 11-year lows in Shanghai, and the 14.2% coverage ratio in New York all suggest it is not the East. The West is selling promises, the East is buying the reality. The countdown to zero inventory has begun. We are approximately 182 trading days away from a mathematical reckoning. Invest with logic, not with noise. Market Crux, signing off.